All right, welcome back to Lunch at the Markets. Today's Jordan Sparks Battlefield Edition brought to you by the catastrophe over in Japan. The first 3 minutes of trading looked absolutely wonderful. That is, unless you were long Shaw Group, which we were. Unfortunately, the loss on Shaw Group was about 942 bucks. We were short calls against it, hoping to be called away this month. So thankfully, those were pretty much worthless. Got to buy those back for a profit, which helped offset the loss on the SmackDown from the Shaw Group. Shaw Group, SHAW, is basically a play on the growing proliferation of nuclear power, which at this point is probably stopped dead in its tracks. So we really want no more exposure to Shaw. Um, who knows? This could be like the BP situation, in which Shaw Group gets whacked initially, then finds some support for a couple days, only to see its stock trade down as people talk more and more about the ending of nuclear power and who has it, who doesn't, who's going to build it, who isn't. So if we see Shaw Group decline further below $30, it's trading around 31 right now. If we see it continue to decline under $30, then we may take a look at some longer dated out leap options. But for right now, it was just better to have the capital than it was to try to play Shaw Group in any way, shape, or form. So the moral of the story really comes from selling calls, right? A lot of times when you're long a stock, especially if you have a big gain, we hear people say on television, I know John Najarian's one, that when he's got a big gain, he sells calls against his position. Well, the problem with just selling calls and not doing anything else is that you run the risk of, say, Cisco, after the second or third or however many times it disappointed. We were hoping to get called away. We had sold some calls at 22 with the stock trading above 22, just hoping to get called away. It was really like 3 days away from options expiration. They report a bad quarter, the stock gets absolutely hammered, and the next thing you know, we're short calls on a name that's trading much, much lower. And the couple $100 that you take in on the short calls is nothing compared to the loss that you take on the actual stock. So how do you protect against the stock that you have big profits in and you'd really rather be called away? You put on a collar, right? The collar is a long stock position. You sell a call above it, use the proceeds of the call to buy a put beneath it. So think about Weatherford and Apple, both of which we've done callers on this year, both of which you can go back and check the editions of Lunch at the Market, and you realize that in both of those situations, having a collar on there saved our butt. So more times than not, you actually have to exercise the downside put rather than being called away. A lot of times, because the stocks are up so much, the risk is really to the downside, and all you're trying to do by selling the upside call is just squeeze a few more dollars out of the stock or a few more percent gain, and then use the profits from selling the call to go buy the put. It's really that protected put that's key to the strategy. I mean, can you think about what would happen if we just sold calls against Nvidia? I mean, that stock went from what, 26, 27 to now trading at $18 a share. We had a put below that, 21, $20. So right now, we have all the time in the world to just kind of sit around and observe and watch the stock. If the stock continues to trade down, say $17, $16, we just hit the execute button on our puts, boom, blow out the stock at the agreed upon strike price above $20, and then, we'll look to re-enter if we like the story. So keep that in mind. When you sell calls against a stock, unless it's like IBM or Apple, in which you need like a tsunami on every country all over the world in order to dent those stories, it's really, 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 there's a lot of risk to the downside when you just sell that call against your long stock. Try to put on a collar instead of just selling that upside call, because, right, your downside all the way to zero. So just be careful if you're selling calls against your stock without using some of those proceeds to buy put protection below it. All right, we will tempt fate on BVN, Netflix, F5, and others, in which the stock trades within $1.75 of where we're short on either side, right? So if we're in the money now, but we're within $1.75, or if we're out of the money, but we're within $1.75 or more, then we're going to hold on to those spreads. We're probably going to look until Wednesday. On Wednesday, we're probably going to be forced to take some action for this month's options expiration, or OPEX. So it's incredibly wild out there. Gosh knows that Japan, on top of the Middle East, gave us more than enough volatility to deal with. So keep your position size very small. Keep an eye on your cash position and raise cash where appropriate. Look, if you're holding on to names that you really don't have conviction in, again, at this point, just take them off the table. Even if you have to take a loss. If you're within, say, 3%, 4% of where you bought the stock at, on either side, plus or minus, and you don't have conviction, take it off the table. There's no reason to be a hero in this environment. Just be careful out there. Options expiration is Friday. Enjoy the rest of the afternoon, and we will see you tomorrow. Thanks for tuning in.